Welcome to the BF Anderson Technical Report for March 24th. Look, I wanted to bring you up to date on what's going on with the new lows on the New York Stock Exchange. Yesterday was kind of quiet. We only had 18 new lows, which is encouraging. However, we have seen an elevated number of new lows over the month, and it is troubling, something to keep an eye on. Also, we're continuing to see some weakness in the small cap stocks. You can see that, right after the election, got a major rally in the small caps. Since the end of last year, we've moved sideways and we have broken down below the moving averages. So just not real encouraging. However, I wanted to set this graph up. This is a graph of S&P 500 earnings. Now, I've always said that the most important factor when it comes to the stock market is two: corporate earnings and interest rates. Now, what I've done here is I've set up a 10-week moving average of S&P earnings. So you can see here back in 2012, 2013, we were coming out of the 08 recession and earnings started to recover. And as a result, the market did rally during this period. And then right around the end of the first quarter of 14, earnings started to flatten out and starting to weaken again, and basically formed a top. And then you can see here, now what I've done here is I've put vertical lines so that as we go through these other charts, you can see the time. But earnings peaked right here around March of 2015 and then started to come down. Now, they just didn't come down, they plummeted. So this is what you call an earnings recession. Now, you can have a general economic recession, which is where the whole economy, meaning the GDP, goes negative for 2 quarters. However, this is what you call an earnings recession. So what happens during this period is no one believes projected earnings, therefore stocks do poorly. So all starting in March of 15 all the way down to June of 16, corporate earnings dropped dramatically. Now, this also had a lot to do with the price of oil dropping. So what then started to happen, and we believe this was the beginning of the next bull market, corporate earnings started to move sideways June, July, August. Then the election comes along, which happens to be coincidental. Everyone's calling this the Trump rally, but I think it's coincidental that corporate earnings have decisively turned up. So as you can see, though, as of the most recent data, corporate earnings have kind of flattened out, and as a result, the market hasn't really gone anywhere. But the first quarter was quite strong. Now, we know that there's a lot of political stuff going on right now with the Obama health care replacement. Now, that's an important vote, and that vote is today. That's an important vote because the next thing that the Trump administration and the Congress are going to pursue is tax policy and hopefully getting us some tax cuts. Now, if we do get tax cuts, especially corporate tax cuts, this line potentially could move up quite dramatically. So it looks like to me that corporate earnings have troughed. We are turning up. Hopefully we don't turn down, but it does look like to me that if we do get the tax cuts, we would see an improvement. At least that's what Wall Street's looking at. Now, again, I had the vertical lines here. I've got quite a few here. This is the 10-year Treasury yield. Now, I really feel that you should keep a close eye on interest rates because they really do tightly correlate with earnings and the stock market. So you can see here, back when earnings started to pick up, the 10-year Treasury went from a yield of about 1.85% and got up close to 3%. And so you can see that all during this period here, interest rates climbed, the stock market did well. Now here we are. This is the peak. This vertical line here is the peak in the corporate earnings, and you can see that interest rates started to plummet, and they plummeted all the way down to in 2016, around August, September of 2016, plummeted all the way down to about 1.35%, which is the lowest interest rate ever in history for the 10-year Treasury. However, since the election and since corporate earnings have turned up, you can see there's been a sharp revival in rates, and it does look like interest rates are in an uptrend. Now, on oil prices, you can see the same scenario here. Here's the peak in corporate earnings, that date. And you can see that in the meantime, the price of oil is dropping dramatically. It dropped all the way from over $100 a barrel, got down as low as around $26 a barrel here in early 16. Now we are seeing somewhat of a recovery here in oil prices, but recently they have turned down slightly. Now, just to kind of just reflect on the market on this, again, you can see that this is the S&P 500 index. Again, the vertical line, the most important vertical line, I think, is the one where we've got, the peak in corporate earnings. So we entered this, what I would call a sideways price box, starting in that period. The market knew that earnings were going to go bad in mid-14, really around the first quarter. Here's the first quarter of 14, and we went into a real sideways market, terrible drop, starting to see recovery. Now, as corporate earnings have picked up, you can see the market has broken out of that box, and this line here is where corporate earnings have turned up. So you can see along with the earnings, the line has turned up. So the conclusion here is that if we get a recovery in earnings, which does look like is happening, the market is going to go higher. However, in the near term here, there's going to be some volatility, so caution is the word. Just kind of keep your powder dry. Don't be in a big rush to do anything right now. If you've got something you're uncomfortable with, you might want to raise a little cash. But just sit tight right now. Do not get super aggressive here. Let's see what happens with this stuff going on in Washington. Thank you.